The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. Each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from our 2017 webinar surveys. So watch for a question you may have submitted. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2018, loyal fans will receive 9 CFP CE credits, 1 for each month. And who knows, maybe one lucky viewer will have a chance to win a 20th anniversary gift from LLIS. Today's presenter started working at LLIS since the beginning. Since then, she's become LLIS's go-to person for connecting your clients with long-term care insurance and variable insurance solutions that meet their needs. And here is Jill McNeil.
Thank you, Claudia. Welcome, everybody. Thanks for joining us today. This afternoon, we're going to talk about long-term care, and we're going to explain what we call our 80-20 rule, and we're also going to discuss other ways to help your clients save money if they're considering long-term care insurance. So let's get started. So today we're going to talk about some stats that show why your client needs to plan for the future and consider purchasing a long-term care policy. And we're going to look at the cost of long-term care around the country and how it varies and how it's changed over the years. And then we're going to get into that 80-20 rule and talk about different ways to reduce premiums for your clients. And then we're going to finish off the conversation by talking about changes in the industry. So why should your clients plan for the future and consider long-term care insurance? Because for your clients that are over age 65, there's a 68% lifetime probability of needing assistance with 2 activities of daily living or being diagnosed with a cognitive issue. And that's important because those are the 2 triggers. You have to satisfy one of those 2 triggers to qualify to receive long-term care benefits if you've purchased a long-term care policy. In the year 2000, there were 13 million people in the U.S. that needed long-term care services. It's projected by the year 2050 that 27 million people will need long-term care services. So that's a huge increase. And 80% of people that have long-term care receivers in the home is provided by unpaid caregivers. So that means probably family members, friends, or neighbors, and who spend an average of 20 hours per week. So think about it. If the son or daughter are providing care for mom or dad, and maybe the son or daughter also work, that's a lot of time that they spend outside of work taking care of mom and dad. And there's a lot of stress put on everybody. And if they have the son or daughter also have their own family, time taken away from their own family. And 58% of caregivers have intensive responsibilities such as assisting with bathing or feeding. So again, a lot of hands-on care provided in the U.S. that's not even recorded in a lot of the facts and figures that we see in talking about long-term care. Here I just want to look at how increasing costs have changed over the years. I found this chart from Genworth's cost of care study, and it shows what the cost of care was in 2004 and what it is this year in 2018. I'm not going to go over all these numbers, but let's look at the cost for the private room in the nursing home. In 2004, just over $65,000. By this year, the median average price for a private room in the nursing home across the country, over $100,000. So prices on average have increased by 3.16%. And you can see for assisted living, home health care, those numbers have also been going up. Assisted living has really increased. But the 3.8%, 3.16%, that's important because when we look at long-term care policies, most policies nowadays are sold with a 3% compound inflation rider. So with that compound inflation rider, the benefit is keeping pace with the increasing cost of care. And what are the reasons for these increasing costs? And these are the reasons for the increasing cost of home health care. The first 3 here are pretty much related: low unemployment, wage pressures, labor shortages. With the low unemployment rates in the country, people can be a little more choosy on where they decide they want to be employed. So maybe they don't want to be employed in the home health care industry anymore. They have better choices. They have higher paying jobs. So therefore, in order to get people to do this business, they have the providers have to pay more to get them. And then the last reason, the sicker patients. I think this is related to the fact that the medical industry has made many improvements over the years. So people are living longer. The medical providers are able to save more lives, but just because they're still living, they may need some more care. And they want to receive care in their home. So there's more demand for home health care providers. So those numbers I showed you before were the median cost around the country. Here I just want to show you how much the costs vary. Oklahoma is the state with the lowest cost of care. Home health aid, $49,718, assisted living, just over $39,000, and nursing home cost is $63,000. But let's compare this to the highest, which is still Alaska. Alaska has had the highest cost over the last several years. Home health aid, quite a bit higher than Oklahoma, but not that much. Assisted living, almost twice the cost. And look at the nursing home cost in Alaska, $330,000. So I think that shows that there's not many nursing homes in Alaska. So looking at these numbers, I think I've decided what my next occupation is going to be. Maybe I should move to Alaska and open up a nursing home. But if I need care, I'm going to move to Oklahoma because it's going to cost a lot less there. So these are really important numbers to keep in mind, not so much these numbers, but keep in mind the fact that cost of care varies around the country. So when you're working with your clients and they're planning for the future, help them look at what cost of care is in their area and plan for those expenses. The highest prices seem to be in the New England area and also California. In the Midwest, the prices aren't quite so high. If you have any question on prices, I can help you find that, or the Genworth Cost of Care Study is a very good website that can give you an idea of those costs. Are your clients in the dark? Many clients are, and what I mean by this is 70% of adults incorrectly believe that Medicare will cover the cost of long-term care. Well, Medicare is not designed to cover the cost of long-term care. It's health insurance. Medicare will pay for 100 days of care, of long-term care, but only after there's been a 3-day stay in the hospital, and within the 36 days, the client needs to receive skilled care. Then Medicare will pay 100% for the first 20 days. Day 21 to 100, you have to pay a copay. After 100 days, Medicare will no longer pay for any type of long-term care services. Medicaid only pays if income and assets are a very low level. It varies around the country, but in most instances, in most states, your assets have to be $2,000 or under to qualify for Medicaid. And monthly income must be less than $2,163 on average. And even if your clients did qualify for Medicaid, and my guess is if their clients are yours, they're coming to you for financial advice, they have a fair amount of assets, and they're probably not going to be candidates for Medicaid. And even if they were, they don't really want to, because when you have to rely on Medicaid, you lose control over where you're receiving your care. A lot of times, in order to get into a Medicaid facility, you have to go where there are beds available, and that may not be near home or near other family members. So again, you lose control if you're relying on Medicaid. So if Medicare and Medicaid aren't good options for you or for your clients, how are they going to pay for long-term care? Well, they could self-insure. If your clients have assets, liquid assets greater than $3 million, they can probably well afford to self-insure. And I say liquid assets because they don't want to have to sell off things to be able to get income or assets to be able to pay for their care. Especially they don't want to have to sell off real estate or sell off other investments at a loss or pay taxes on it. So even if your clients do have this high amount of assets, 3 million or more, they may be good candidates for hybrid policies. With the hybrid policies, they're getting something for the money, either the long-term care benefits or the death benefits or the return on premiums. So they know that they're spending their own assets to get the care, but they're going to get something back for it. Your clients that have liquid assets less than $500,000 but greater than $3 million may be good candidates for long-term care policies. If they have assets less than $500,000, paying the premiums on a long-term care policy may be very hard on their budget. And as I said, if they have over $3 million, then they can probably self-insure. And this is just a rule of thumb that we use here at LLIS. It's not set in stone. Of course, there's variations on this, and your client's own circumstances. You have to sort of take this as a guideline. Again, it's not something hard and fast. What are the advantages if your clients decide to purchase a long-term care policy? Well, there's some immediate advantages. With a long-term care policy, they have an immediate pool of benefits that they can have access to from day one. So if they purchase a policy today and become sick tomorrow, right away they have that large pool of assets or pool of benefits that they can use. They don't have to worry about saving money over a period of years to build up that pool. And by having a long-term care policy, they have access to a care coordinator. A care coordinator is provided by the insurance company. If your clients have a policy, they're either an employee of the insurance company or a third-party person, and many times it's a health professional or a medical professional. And if the policyholder files a claim, the care coordinator can come up to the home and visit with the insured and the family members and help assess the situation. Where does the policyholder want to receive care? Do they want to receive care in their home? And if so, what renovations need to be made to the home? Do we need to put on wheelchair ramps or maybe some assistance bars in the showers? And those renovations can be covered by the policy. So again, access to a care coordinator can be a very nice thing at a time of need. If mom or dad have a stroke and all of a sudden the family needs help with the care coordinator can come out, and also the care coordinator can provide lists of home health care providers in the area and also provide lists of facilities in the area. And also, by having a long-term care policy, it provides peace of mind. Your client can think to themselves, okay, I've taken care of this. I have this policy in force. I've planned for the future. So if the worst case scenario happens and I do become sick, I have this policy in force and I have an immediate access of pool of benefits and that care coordinator. And help your clients understand that a long-term care policy is a gift to the family also. It's not just for themselves, but it's to the family members. As we saw earlier in my statistics, a lot of care is provided by unpaid caregivers, family members. And if you have this long-term care policy, the family members don't need to be the ones providing care. They can just coordinate it. They can manage your care. Therefore, the daughter or son do not have to put aside their own life to take care of the family member, because it can become very difficult. Providing care can add a lot of stress to the family, both physical and emotional, because providing care does not always bring a family together. It can pull them apart. Think about it. If the son has to be the one assisting the mom with a shower, not a very nice thought. Okay, I'm sure the son would rather pay or have a policy pay for a caregiver to come in and provide that care. So now that we've determined that your client should plan for the future and take in mind those costs that it could cost them if they need care, let's talk about designing a policy, a long-term care policy. And here's where I'm going to get into talking about that 80-20 rule. This is LLIS's 80-20 rule. Many times when we have clients come to us looking for a long-term care policy or with their advisor, they don't know what benefits to ask for. So this 80-20 rule is kind of a guideline that we've come up with as a starting point when designing policies. So when I talk about the 80-20 rule, what I mean is I start by looking at cost of care where your client's going to need care. So I use that Genworth website, find out cost of care in their area. In this case, for this case study, we're using Sandra, age 60, and we're saying Sandra lives in Atlanta, Georgia. So looking at the cost of a private room in a nursing home in Atlanta, the median cost for this is $232 a day. That $232 includes the cost of food and some other essentials that Sandra would have to budget for even if she wasn't in a nursing home. So in that $232 includes the cost of food and other essentials. So we recommend taking 20% off of that number. then the other 80% represents what it would cost her out of pocket for the nursing home. So in this case, we'd recommend Sandra consider a daily benefit of $190 a day. We'd recommend a 90-day elimination period. This is kind of the sweet spot on these policies. Also, your clients can probably well afford to take care of the first 90 days. They probably have emergency funds. And that 90 days also works well with Medicare. If your clients are fortunate enough to receive care through Medicare, remember the first 100 days may be taken care of. So if Sandra went on claim and started the claim process on our long-term care policy, and was receiving care with Medicare after the 100 days with Medicare are up, she will have also satisfied that 90-day elimination period on her policy, so then she could start to receive benefits right away. We'd recommend a 4-year benefit for Sandra. The reason for this is the average length of stay for a female in a nursing home is 3.7 years, so with the 4-year benefit period, she should have most likelihood have that taken care of. And it gives a little time if she wants to receive care in her home first. And then we'd recommend a 3% compound inflation rider on the policy. This way the policy will keep growing by 3% every year. Remember, we saw earlier where prices have been going up around, for cost of care, around a little over 3%. So this helps keep pace with costs. Sandra's annual premium for this policy, $3,849. Well, Sandra's okay with that, but she thought, well, what could I do to get this policy down a little more? And she's done some reading. She's seen that the majority of long-term care claims begin and end at home. So here we go. 54% of care is provided in the home. 14% is provided assisted living facilities. And 32% is provided in nursing homes. So as you can see, the largest part of care is received in your home and assisted living. So, and 56% of claims ended at home. So what may happen is a client may, or a proposed insured may start to receive care in a facility, maybe a hospital, or go to a rehab facility, but then they become well enough to go home because that's where they want to receive care and be in the home in their last days. So 56% of claims ended in the home. So looking at those numbers, those facts, what does care in Atlanta cost? Homemaker services, $125 a day, home health aid, $125, and assisted living. And some of you may be wondering, what's the difference between a homemaker services and home health aid? Homemaker services, somebody comes into the home and does some basic things such as cleaning the house, preparing meals, getting groceries. Home health aid provides a little more hands-on care, maybe assists with dressing or bathing, taking the medication. And assisted living, we all know what that is. So we'd recommend Sandra consider a daily benefit of $130 because with $130, she'd have the cost of those 3 services under control. And with the thought that if she needed to go in a nursing home, she would have to supplement with her own savings. By going down to $130 a day, her annual premium would now be $2,634. with an annual savings of $1,215 per day. So she still has a nice basic policy. Not everybody needs the Cadillac of policies. So again, with that 80-20 rule, that's a starting point or a guide rule, and then we can work from there. And it's very important for your female clients to plan for the future. And why is that? Because on average, women live 5 years longer than men. And 80% of women are single at death. In nursing homes, 3 times the number of women in nursing homes. And 2/3 the long-term care claims are by women. So these reasons are led to the fact that the insurance companies, about 3 or 4 years ago, the long-term care companies went from using unisex rates to gender-specific rates. So rates for females are a lot higher because of this. It showed that women go on claim a lot more longer. So taking this into consideration, we've taken these numbers for women into consideration. is a reason why we often recommend a shared care policy. So our clients that come to us that are couples, we strongly recommend a shared care policy, and for several reasons. Let's look at Tom and Susan. Again, we're saying they live in Atlanta, and we're looking at the daily benefit $190, a 90-day elimination period, 3% compound. So if they were to consider 4 years each of benefits, the premium would be $5,180. But if they went down to 3 years each and added that shared care rider, their premium would be $5,062. So we're saving them a little bit of money, not a whole lot, but adding the shared care rider means they can share their coverage. The shared care rider works differently with each company, but basically it means that they have about 6 years to share between them. So it adds flexibility to the policy. And so let's show a little bit further how this works. So let's say, again, they're enjoying life and living large, and what if something happened to Tom and he passes away without using any of his benefits? Then Susan would inherit his unused benefits, so now Susan would have 6 years on her own, and she can ride through life on her own having those benefits, and Tom's portion of the premium drops off. So now Susan only has to pay for her portion of the premium, $3,060. So remember how we saw that women usually go on claim for longer? Well, this is one of the nice benefits of the shared care policy, because we never know who's going to need more care than the other, but in most cases it's the female. But either way, if the female passes away or the male, unused benefits can be shared by the partner. All right, now let's talk about inflation options. Many years, well, not that many years ago, but 5 or 6 years ago, when I first got into the industry, the long-term care industry, the majority of the policies we sold had a 5% compound inflation on them. But nowadays, we sell very few policies with 5% or 4% compound inflation because the premiums are so high on those options. But we have some choices, and when we're looking at 3%. We can still get 4 and 5% and even 1 and 2% with Mutual Omaha, but majority of policies nowadays are sold with 3% inflation, and some of the companies have some options on this. So let's look at Judy, who's age 65, and Greg, age 65, are also saying they live in Atlanta. And this is the benefit, these are the benefits that we're looking at. They just want one of those smaller policies, $130 a day to cover home health care and assisted living. But so we'd say 130, 90-day elimination, 3 years shared care. But when it comes to inflation, do they want the inflation compound rider that would last for their lifetime? So by that we mean that the benefits would grow by 3% through the life of the policy, or do they want to consider the 3% option that only lasts for 20 years? So what this means in 20 years, by the age of 85, the policy would no longer continue to grow. The benefit would stay at the level that it had grown to. So let's look at the difference in prices on this. So the premium for the lifetime inflation, $4,787, and that's their combined annual premium. If they went with that 20-year inflation option, the premium would go down to $4,358. So we're saving them a fair amount. Annual savings of $428. So let's say they went on claim at age 85. By this point, a lot of people do go on claim. So if they were to both go on claim at this point, the premiums would be waived because they're on claim, if they're both on claim, and they would have saved over $8,560 in the 20 years because they went with that 20-year inflation option. Okay, I see that I'm receiving a fair amount of questions. Okay. One of the questions that I see are, what are typical conditions that disqualify somebody from receiving a long-term care policy? Well, the long-term care underwriters are looking for pre-existing conditions that may cause somebody to have difficulty doing the regular activities of living in the future. So if they have arthritis, or if they have some spine or back issues. Those are the two big things that cause a lot of people to be declined. Because with the arthritis, it usually leads into disabilities where they can't take care of themselves. They can't get out of the chair, or they can't transfer from bed to a chair. Anybody that is receiving physical therapy, they're not going to be insurable for long-term care. The good news is after the physical therapy is done, if everything's resolved, then they can be able to get care. Somebody that has MS, they would be an automatic decline. Somebody that has type 1 diabetes and is using more than 50 units of insulin per day would be uninsurable. Somebody that's had cancer in the past, that is not something that disqualifies you. If your client's had cancer in the past and it's in remission and everything's good, and especially if it was early stage cancer, then a good chance that they will be insurable in the future. If they've had a heart attack and it's been 6 months since the heart attack and it was not a major heart attack, there's no permanent damage, then they would be insurable. So again, the problems qualifying for long-term care are morbidity issues, not mortality issues. Okay, then I'll answer one more question at this point. I'm curious, if the average nursing home stay for a female is just under 4 years, what is it for a male? For a male, average stay is 2.2 years. All right, moving on here. Let's talk about couples discounts. All right, here we have Joe and Mary. Well, Joe's a little bit stubborn. He does not want long-term care. I'm not saying all males are stubborn, just some of them. But Mary wants care. She wants to purchase a long-term care policy. Maybe she has some family history in her family of cognitive issues, so she wants to plan for that future. So we're saying Mary lives in Tampa, and looking at the 80-20 rule, we recommend a $250 benefit. Again, the 90-day elimination, the 4-year benefit period, and 3% compound inflation rider. So Mary qualifies for a 15% spouse discount because she has a spouse living in the home with her. Even if Joe does not apply for coverage, Mary still gets a 15% discount. So her annual premium, $3,706. But if Joe applies with Mary, they would both receive a 30% discount. They don't have to apply for the exact same benefits, so Joe could apply for a very minimal policy. Could not be a shared care policy because in order to have shared care, Joe and Mary would have to apply for the same benefits. But so for Joe, he just wants that little policy so he can get that spouse discount for Mary and for himself. So minimum daily benefit, $50. In this case, the lowest elimination period in his state was 90 days, so we couldn't go with a longer. Some states we can go a 365 day and make the even lower premium. Minimal benefit, 2 years, and no inflation rider. So Joe's premium, $223 a year. Mary's premium goes down to $3,052, so their combined annual premium of $3,275. And remember, Mary's getting the same benefits that she wanted originally. It's just Joe that's going for this small policy. Savings of $431. Not a huge saving, but over time, $431 adds up. Plus, Joe now now Joe has a policy that he could use. $50 a day is better than nothing. More than a drop in the piggy bank. Okay, I'm just reading another question here. It says, are premiums affected by the location of the insured? For example, are the premiums the same for the same policy, the same across the states? The answer to that is no. In most states, the premiums are the same, but some states, the premiums are higher. So we really do have to look at premiums. Once you do have a policy, policies are portable, so you can take it to another state, and you're still paying the same premium that was when you purchased the policy. All right, 2 is better than 1. Now, this is a real case study that, it's not a case study. It's a real case that came to us several months ago. And we've changed the names, but we're calling them Kirk and Kathy, both age 64, and they live in Ohio. They came to us with their advisor looking for a long-term care policy. And again, using what I call our LLIS special or the 80-20 rule, we recommended these benefits, the $6,900 a month, 93 years shared, and 3% compound inflation. This policy would have an annual premium of $8,113. So I showed them that, but they also wanted to look at some hybrids because Kirk has an existing life insurance policy with $36,000 in cash value, and he wanted to see he and the advisor wanted to see how they could use that. Well, we cannot use that $36,000 and roll it into a joint policy for both Kirk and Kathy. The rules of 1035 exchange will not allow to roll from an individual policy into a joint. So if we wanted to do a hybrid life policy for the two of them, we'd have to do individual policies. So I quoted a hybrid life for Kirk using his $36,000 and also quoted a hybrid life for Kathy, her own individual policy. She doesn't have any cash value, so it would be all straight premium for her. We looked at hybrid quotes for the $6,900, so the same monthly benefit that we were looking at on the traditional long-term care policy. We looked at Lincoln Money Guard, which has a 0-day elimination period. 4-year benefit period. Remember, we cannot do shared care because, but we cannot do shared care. So they'd each have their own policy. And these policies work best because of the way the riders and the base policy, if we do a 4-year benefit period, added on to 3% compound inflation, and this policy would have a minimal death benefit of $165,600. So Kirk's premium, along with that $36,000 dump in, or 1035 exchange, he would have a 10-pay premium, meaning he'd pay the premium for 11 years, so he'd have to pay an additional $11,961 for 10 years. And Kathy's premium, her 10-pay premium, the $17,800, and that's straight premium because she has no 1035 to roll over. So after looking at these hybrid options and the traditional long-term care, the advisor and the client and I had a phone call. We looked at all the options, and what we decided on was to look to see if Kirk just used that $36,000 and see what that would purchase him on a hybrid policy, what would the result be? So again, the $36,000 would alone, with no additional premiums, would provide him a monthly benefit with a hybrid policy of $2,500, 4-year benefit period, and 3% compound inflation. So considering that they wanted a monthly long-term care benefit of $6,900, that's the goal, Kirk still needs an extra $4,400 of monthly long-term care benefits. So it was decided that he would apply with Kathy together for a long-term care policy. Kathy would apply for the $6,900 and Kirk would apply for the $4,400. So by applying together, they get that 30% spouse discount. They cannot have the shared care rider because they're not applying for the same benefits. Their combined annual premium for this long-term care policy is $6,027. So we're saving them $2,086 in comparison to that original long-term care policy that we looked at. So we're taking that $36,000 of Kirk's that he had and that existing life insurance policy where he no longer needed the death benefit and using it to get him a small policy, and again saving them the $2,086 annually. Okay, I'm just reading another question here. In your prior example, could Joe then cancel his policy after some period of time and the spouse still receive the discount? Yes, he could. So we're talking about Joe and Susan, the shared care. Yeah, he could cancel his policy and Susan would still have her discount. All right, now again, let's talk about long-term care for women, and this is an actual case study that I put together just to give you an idea again on how to save some money. So Grace, age 61, we're saying she's widowed and lives in Panama City, Florida. Looking at cost of care in her area, we'd recommend $200 and those benefits that we've been talking about. Grace's premium would be $4,052. Well, Grace has a health savings account. And remind your clients that if they have a health savings account, they can use money in that account to pay for their long-term care premiums. But the amount they can use is limited by that IRS age-based table. But as you can see in this case, Grace could pay her whole premium out of that health savings account. So just another way that they can access some money that they may have set aside for some health care costs. All right, all along we've been talking about saving money. So along this line, let's look at cost of waiting. If your clients decide to wait to purchase a policy, they're going to spend more money. And there's other consequences for waiting to purchase a long-term care policy. Their health could change, making your clients uninsurable. It's always better to apply when you're young and healthy. Hate to say it, once we reach our 50s, our health never gets any better. Usually it just gets a little worse. And not to be a downer here, but in reality, once we hit our 50s and 60s, we start taking a few medications on a regular basis, and this is a time when things change. So it's always better to apply when you're young and you're healthy. And premiums are based on age at time of purchase. So every year they wait to purchase a policy, premiums go up. And if you wait to purchase, you may need to purchase a higher benefit to keep up with inflation. If they purchase a policy several years before and add that inflation rider, that benefit's going to keep growing. And so if they don't purchase policy and wait 5 years, they're going to have to buy a bigger policy. So here's an example of what I mean by that. Here's Henry, age 54, and this is the long-term care policy he's considering purchasing. If he buys this policy now, his premium will be $2,706. If he waits 5 years to purchase the policy, he's going to have to purchase a policy with a $225 daily benefit because he had that 3%. He was looking at a 3% compound inflation, so that policy is going to keep growing. And you can see how much the premium has changed. Wait another 5 years, it goes up even higher. If he waits till age 69, 15 more years, look at the difference in premium. So he'd have to buy a policy with a $300 daily benefit, premium quite a bit, over 3 times higher than what he was originally considering. So let's look at if he went on claim at age 85. Let's say if he went on claim at age 85. If he purchased the policy at age 84, he would have spent a total of $83,886. If he waited till age 69, he would have spent over $117,248. So again, not only does he save money by purchasing at age 54, he locks in his insurability. Here's a chart I wanted to put up here just to give you an idea of when most policies are purchased. And I see that I have a question here. Is there an optimum age to apply? Well, this sort of answers that question. Average age issued is 55, so most policies purchased are purchased in the sweet spot between age 55 and 64. And why is that? Well, we think it's because by that time, your clients are thinking ahead to retirement. They're concentrating on what they need to have in place for retirement. The concentration has moved from earning assets and building up their assets to thinking about retirement and depleting those assets. So the concentration is there. And by that age, they also may have gone through this with their parents. I've seen their parents go on claim and see how that affects their parents' assets. So again, I would say, as this shows, the optimal age is mid to late 50s to purchase a policy, not too. But you can also purchase younger. It's not too early to purchase in your 40s. Probably, I wouldn't recommend in 30s, late 40s is probably a good time. All right, let's talk about tax deductions for long-term care premiums. So different states may offer state income tax deductions for long-term care premiums. I'm not going to concentrate on that now. I'm just going to talk about national or federal taxes, and consult a tax professional for any tax advice. I am not a tax professional. I'm just giving you an idea of what's out there for your clients. So if you have an individual and they itemize their tax deductions, if their medical expenses, including their long-term care premiums, are deductible if they exceed 10% of their adjusted gross income. But the long-term care premiums treated as medical expenses are limited to the eligible amounts defined by that IRS age-based table. And this is the same table that we showed when we talked about the health savings account. So in the early years, it's not very much, but when they get over 60, a fair amount they can deduct, and then over age 70. If your client is self-employed, can deduct 100% of out-of-pocket premiums up to that age-based table, IRS table. The nice thing is it's not necessary to meet that adjusted gross income threshold. And the deductible amounts are eligible for or paid can also be for spouses or dependents that they've paid for. If it's a partnership, LLC or subchapter S Corp, the company pays the premium. The individual must include that long-term care premium paid for him or her and in their adjusted gross income. And they may deduct 100% of that age-based eligible premium amount, and it's not necessary to meet that AGI threshold. Where it really looks nice is when you're looking at C Corp. So the employer pays the premium for the employee or the spouse or dependent, and the business can take 100% deduction on the total premium paid. The deduction is not limited to that IRS table. And the employer can select on the classification of employees it covers. So they can carve out a niche of employees. They can do the high-level employees and determine who they want to cover there. And the deductible amount can also include premiums paid for spouse or dependents. And for the employee of the C Corp, the long-term care premium paid by the business is excluded from their AGI. And even if the premium exceeds that exceeds that IRS age-based table. So very nice for C Corp. Now here I want to shift gears here and talk about a new option, and this is a new product that's come on the market, and it's been around for a couple years, but just recently LLIS started offering it. When it first came out, the companies that were offering short-term care were not companies that we felt were financially secure, but this year we saw Aetna is offering it, so we decided to look into it and add it to our base of products that we're offering. So short-term care is very similar to long-term care, as the name implies, but the difference is the benefit period is shorter. It provides coverage for nursing home, assisted living, and home health care. Benefit amounts from $10 up to $300 of a range of elimination periods. You can see we can have a 0-day elimination period. Clients that sometimes want a 0-day elimination period on traditional long-term care policy, but it's not available, but they could get it on the short-term care. Benefit period, 90 days up to 360 days. And look at this issue age, 50 to 89. So some of your older clients that maybe missed the boat for traditional long-term care could get one of these short-term care policies. And simplified underwriting. There is some underwriting on this policy, but not a great deal, certainly not as much as traditional long-term care. Medical records are ordered at the discretion of the underwriter. There is no exam. There is a phone interview also. Along with the base policy, which is the nursing home, you do have to have a daily hospital indemnity benefit on this policy. So what this means is if your client were to enter a hospital, they'd also receive an additional benefit on top of their regular health insurance. So the benefit amount on this indemnity, hospital indemnity, $10 to $300 a day, must have at least one $10 unit on the policy. And they would start to receive benefits the first day of the hospital stay, lifetime maximum of 365 days. And we can add a home health care rider onto this policy. So again, the base policy is nursing home, then we have the hospital indemnity, and then we can add the home health care rider. And we would certainly encourage your clients to add the health care rider, the home health care rider on this, because most people want to receive care in their home. In order to qualify for benefits, they must receive at least 3 days of a week of care in the home for at least 1 hour. So that's not very much. The benefit amounts from $150 up to $1,200 weekly. Benefit period 13, 26, and up to 52 weeks. Who's a good candidate for this short-term care policy? Well, those clients that want a less expensive option. Maybe they don't have the budget to afford a traditional long-term care policy or a hybrid policy. This is a nice option for them. Or maybe they've been declined for traditional long-term care because of a pre-existing health condition. As I said, the underwriting is simplified for this policy. Or your older clients, as I showed you, available up to age 89. If their net worth is less than $500,000, remember that rule of thumb I showed you earlier? Again, if they can't afford the higher premiums, this is a good option for them. So I did a case study here to give you an idea how much the premiums cost on this policy. Susan, age 56, we're saying she lives in Denver, Colorado. Looking at cost of care there, we'd recommend $240 daily benefit. Benefit period, 360 days, the longest option available. And a 100-day waiting period, elimination period. So that benefit period says 360 days, but she can have that benefit twice in her lifetime. So let's say, for example, Susan became sick and received 360 days of benefits, and then her health improved and she got better. And then maybe 2 years down the road, she became sick again. She could receive another 360 days of benefits. We put a daily hospital indemnity of $50 a day, home health care, the maximum $1,200 a week, and maximum benefit period 52 weeks. Her annual premium $722, which I think you would consider quite affordable compared to those other premiums we were looking at. So again, for your clients that are a little more on the budget, this may be a nice option for them. Talking about policy reviews, I receive a lot of requests for policy reviews, and I'm always happy to do it. In order to do a policy review for your client's long-term care policy, I just need their dates of birth, state of resident, and if we can, the most recent annual statement of benefits and the premium on their existing policy. I especially get these requests when people are having rate increases. Well, I want to say with all the policy reviews I've done, I don't think I've ever told anybody to not keep the current policies. Even though we're having they've had rate increases on their older policies, a new policy today is going to be probably a lot more than what they're currently paying. Here's an example of a policy review I had recently. Diana and Brian, they purchased a Genworth policy back in 2011. That policy had these benefits originally. Policy is growing, but their annual premium, their original annual premium, $2,958. But they had in 2018, Genworth did a 51% rate increase. Their new premium, $4,481. So they came to us wanting to know if there are better options out there for them. Should they purchase a new policy? Well, I ran quotes to see what a new policy would cost them today with the same benefits that their old policy currently has. Premium $15,121. Well, I think they were pretty happy to hold on to that old policy. So even though we do a policy review and usually tell the clients to hold on to their policy, it usually makes them feel very good when they see what the premiums are on a new policy. Here I want to end up my presentation by talking about how the long-term care industry has changed over the years. So what's the history of long-term care insurance? Well, the long-term care policies or industry has been around a lot shorter period of time than life insurance. Life insurance has been around for many years, but long-term care just came out in the 1970s. And it caught on very big in the 1980s, early 1990s. In late 1990s, we had 100 plus long-term care companies offering policies. But by the year 2014, there were less than 15 long-term care companies, and I'm talking about major long-term care companies. We're talking about companies that issue at least 2,500 individual or group policies per year. So there are more than 15 long-term care companies in the business, but only about 15 major players in the business. But let's show the need for in the 1970s, there was $20 billion in long-term care expenditures. In 1980, $30 billion in long-term care expenditures. Today, $225 billion in long-term care expenditures. So what I mean is $225 billion being spent for long-term care on providers and facilities. So even though the need is going up for long-term care, companies offering policies has gone down. So what's the future? The American Association for Long-Term Care Insurance did a poll, and they polled actuaries, and on September 17th of 2018, they released the results of that poll. And most actuaries responded to seeing little to no risk for needing future rate increases on recently priced policies. So I'm talking policies in 2018. And why is that? What changes have happened? Well, there's now several decades of experience. The actuaries have several decades of experience to see the results of these policies that have been sold. They've had hundreds of thousands of claimants. They have an idea how many claims or how claims are going to be they're exposed to, and also lapse rates. So they've had something to base it off. Originally, policies were not priced right because the actuaries didn't have any experience to base it on, but now they do. Today's interest rates are slowly going up. More standardizations and regulations are in the long-term care industry. They've got a better handle on it. Again, they've got a better handle on claims and lapse rates. And the insurance companies have moved, most of the companies have moved to gender-specific premiums. They're no longer using those unisex rates because history has shown that women go on claim longer and more often. They've modified the policies. They've taken away a lot of the riders. They've taken away the unlimited benefit periods. In reality, most people do not need unlimited benefits. And with the unlimited benefits gone away, the companies don't have that exposure to the unlimited benefits and not knowing how long claims are going to last. It's hard to price something you don't know how long claims are going to last. So of those 80 actuaries that were polled, 79.1%, it responded that they expressed the risk was 10% of less of having to have in rate increases on new policies going forward. And 12.5 of them responded that they predicted that the likelihood of future rate increases at 20%. And 4.2% said predicted the likelihood of rate increases about 30 to 40%. And only 4.2% said responded the likelihood of rate increases 50% or more. So looking good for the long-term care industry, or improvements. Hopefully things are going up. So we looked at, but you can see how things have changed. We'll show you how things have changed. We found a quote from 2013 that we made, and we're using Thomas and Gretchen here. So a policy with those benefits, back in 2013, this policy would have a premium $5,517. Running a new quote today for the same benefit for, if we said clients are age 61 and 62, so in today's premiums for the same age clients, using two long-term care companies we use, one company $7,211, another company $7,800. So you can see how premiums have changed because of those changes in the industry. The actuaries are pricing the products more accurately. For women, because of the change to gender-specific rates, the premiums for women have changed quite a bit. 2013, if Cindy applied for the policy with these benefits, her premiums would have been about $3,100. Today, for the same policy for a 47-year-old female, she's going to pay a range of rates. If with one company, Mass Mutual is still using those unisex rates. We've been told by Mass Mutual they're going to change that in the near future, but for now, females can still get unisex rates with Mass Mutual. So Cindy would have a premium of $3,525. With Mass Mutual, but if she went to Mutual of Omaha, who is using those gender-specific rates, her premium would be $6,500. So you can see how going to gender-specific rates has really affected premiums for females. Another way to eliminate the risk of increased premiums is to encourage your client maybe to consider a hybrid policy. In 2017, there were 4.1 billion in hybrid sales. This represents 260,000 of long-term life policies sold in the U.S. in that year. So the hybrid policies are really catching on. So this represents 25% of new premiums, life insurance premiums in 2017. They like the hybrids because of the guaranteed premiums. They don't have rate increases. And they also get a lot of other guarantees with the hybrids. Back in 1987 was when the first hybrid policy came out. That's the Lincoln MoneyGuard policy. Back in 97, we were looking at Dirty Dancing as one of the prime movies out. We were learning to walk like an Egyptian. And we were telling Gorbachev to tear down that wall. So lots has changed. So we have more hybrid policies nowadays. We don't just have the Lincoln. We have 4 companies that offer a very similar hybrid policy, and we have State Life. The State Life policy is a joint hybrid life. It's the only company that offers a joint. So I'm going to concentrate on those 4 hybrid policies, and I am running out of time here, so I'm going to be a little bit quick here. Lincoln has 2 options on the hybrid policy. You can have return of premium 80% or 100%. Pacific Life, Minnesota Life, Nationwide. All of these policies are hybrid policies, are all very similar. They all have return of premium. They all have inflation options, all have a death benefit. Some of them are reimbursement form and some of them are indemnity. Real quick on this, the focus I would say would probably be on the maximum long-term care benefit. So that Minnesota Life policy is looking the best with a $5,600 monthly benefit and also has the largest death benefit. So here, just gives you an example of all the different options available. And also that Minnesota Life policy is an indemnity policy, which is nice because with indemnity, you don't have to submit bills at the end of every month. The insurance company would just send a check once you go on claim. What does the future hold for the long-term care industry? Well, as we've seen in the last 5 years, we've had more of the hybrid policies coming out. When I'm talking about the hybrids, these are permanent life insurance policy with a long-term care rider. But since the industry has made the changes, the traditional long-term care, in the next 5 years, maybe we'll see some of those long-term care companies come back on the market because they already have the systems in place to offer long-term care policies. And I'm talking about the traditional long-term care. They already have their system set up. And there's more reliable pricing now because they have the experience. And by having more companies come back in the traditional long-term care, more competition. More competition is always a good thing. Help keep the premiums at a level mark. So, as I said, it looks like things are leveling off and things should be good in the future for traditional long-term care, but we still have the options for the hybrid policies. So, ending up, I want to remind you all that we are offering our Academy again this year in February 20th to 22nd on Clearwater Beach. 2 days of intense insurance, but we also have a lot of fun at that event. I have some questions here that I will try and get to. Let's see. Oh, here's some more questions coming in. Okay, somebody asked, can you please explain the 80-20 rule again? Specifically, why you decide to insure the daily benefit of 80% of the average nursing home stay? Okay, so again, we look at the cost of care, and let's say the cost of care was $300 a day. So that $300 is what they say it is for the nursing home. And when you go into a nursing home, in that $300, it includes a price of food. You don't have to pay extra for your food. So if you are not in a nursing home, your client's going to have to budget to pay for food. So they're already going to have in budget the cost of food and some other little essentials that if they go into a nursing home would be covered. So about 80% of the number, 80% of that 300 is what it's going to cost them out of pocket to pay for that nursing home. So that's what we recommend they insure, that 80%. So in that case, $240 would we say that they should cover. So again, 80-20. 20% is food and other essentials that are already in the budget. The 80% is what they'd have to budget for out-of-pocket nursing home expenses. I think that's it. Running out of time here. There are, maybe time for one more. If children buy long-term care policy, I lost the question. I'm sorry. Okay, one more question. Does family history of old age dementia disqualify someone from long-term care policy? Several years ago, the dementia issue was not a big deal. If the client had a family history of dementia, what it meant was they couldn't qualify for the preferred discount. Most people qualify for select underwriting class, which is the second underwriting class. If your client is in excellent health, they may get a preferred discount of 15%. So years ago, if they had a family history of dementia, they couldn't qualify for that 15%. Companies are changing the rules now. Mutual of Omaha came out in July with a change. And with their new underwriting guide, Mutual of Omaha now says if there's a family history of at least one parent with dementia, then they're going to limit the amount of benefits the insured can get. They're going to limit the monthly benefit to $5,000 for the client that's applying for the policy. It doesn't matter what age the parent was diagnosed with dementia. If it's, doesn't matter again if it's in its 70s, 80s, if there's any evidence of dementia, the maximum benefit is $5,000. That's with Mutual of Omaha. If there's history of dementia in both parents, then that client is uninsurable. Again, this is only with Mutual of Omaha. I have not seen it with Mass Mutual or Transamerica yet. I will say a lot of times companies follow what other companies have done. So it wouldn't really surprise me that in the future we see Mass Mutual and Transamerica going this way also. All right, thank you everybody for attending. Any questions that I have not answered, I will answer them in an email to you specifically. The slides will be available if you request them, so just let us know. Thank you. Bye-bye.